What if I told you that having over $1 million in your RRSP could actually create a massive tax problem in retirement? Here's why. Most Canadians focus so much on building their RRSP that they never stop to ask, what happens when I have to take it out? At age 71, the government forces you to start withdrawing from your RRSP by converting it to a RRIF. And if you've saved diligently, built a 7-figure RRSP, those mandatory withdrawals can push you into the highest tax brackets, trigger old age security clawbacks, and even leave your kids with a huge tax bill when you're gone. But here's the good news. With the right strategy, you can melt down your RRSP on your terms, reduce your lifetime tax bill, and leave more for your family. Hi, I'm Darcy Bell, a certified financial planner professional with IG Wealth Management. I help Canadians grow, protect, and optimize their wealth, especially during retirement. In this video, we're going to break down why a large RRSP can become a tax trap and how the RRIF Meltdown strategy can help you draw down your retirement savings in a tax-smart way. If you want to keep more of your hard-earned money and avoid costly mistakes, make sure to like and subscribe. And if you like to see how these strategies could apply to your own retirement plan, you can book a time with me using the link in the description below. Now let's dive in. Part 1. Why the large RRSP can be a tax trap. For most Canadians, the RRSP has been a cornerstone of their retirement savings. You've contributed every year, taken advantage of the tax deductions, and now, decades later, you're sitting on a portfolio worth over $1 million. Feels like a success, and it is. But here's the part no one warns you about. At age 71, the Canada Revenue Agency requires you to convert your RRSP into a RRIF. And once that happens, you're forced to start withdrawing at a minimum percentage every year. Whether you need the income or not, here's the problem. Those withdrawals are fully taxable as income. Combined with CPP and OAS, they can easily push you into a higher tax bracket. And if your income crosses that $90,997 in 2025, your OAS benefits start getting clawed back. For example, let's say you have $1.2 million in your RRSP. At age 72, the government requires you to withdraw at least 5.28%, which works out to about $63,360 that year. Add on 2 CPP pensions and OAS for you and your spouse, and suddenly your total taxable income could exceed $110,000. That's when the tax dominoes start falling. You're paying more tax at higher marginal tax rates. You could lose part or all of your OAS. And if you pass away without careful planning, your RRIF may be fully taxed as income on your final return. Your kids could lose 40 to 50% of your hard-earned savings to the CRA. This is what we call the tax bomb effect, and it catches many Canadians completely off guard. Part 2. What is the RRIF Meltdown strategy? The RRIF Meltdown is a tax planning strategy designed to reduce the size of your RRSP before the government forces you to take large withdrawals at age 71. Here's how it works in simple terms. 1. Start early. You begin withdrawing from your RRSP earlier, often in your late 50s or 60s. The idea is to spread out withdrawals over a longer period of time to avoid large forced withdrawals later. 2. Withdraw strategically instead of waiting for age 71. You take out just enough each year to top up your income to the top of the lower tax bracket. For example, if the first tax bracket in your province goes up to $53,000, you might withdraw enough to fill that bracket, but not spill over into the next one. Number 3, reinvest the withdrawals. You reinvest the after-tax funds into TFSAs, non-registered accounts, or even use them to purchase prescribed annuities or tax-efficient investments. These vehicles generate income that's taxed at a lower rate, or not at all. Number 4, optional. Use life insurance. Some Canadians use the withdrawals to fund a permanent life insurance policy, which grows tax-free and can provide a tax-efficient transfer to their beneficiaries. The goal of the RRIF Meltdown is to shrink your RRSP balance so that your mandatory withdrawals in your 70s are smaller. Your lifetime tax bill is lower. You avoid or reduce OAS clawbacks. You leave more to your heirs instead of to the CRA. It's not about avoiding tax entirely, it's about controlling when and how you pay tax. Part 3, a real-world example. Let me share a case study to show you how powerful this can be. John and Linda, both 60 years old, had a combined RRSP balance of $1.5 million. Their plan was to leave the RRSP untouched until age 71, then start withdrawing. We ran the numbers and found at age 72, their mandatory withdrawals would be over $80,000 per year. Combined with CPP and OAS, their taxable income would exceed $130,000 annually. They would lose 100% of their OAS benefits due to clawbacks. And if they both passed away in their 80s, their estate would pay over $600,000 in taxes on the remaining RRIF. Here's what we did instead. They started withdrawing $60,000 per year now, topping up their income to just below that next tax bracket. The after-tax funds were split between their TFSAs and a portfolio of dividend-paying, tax-efficient investments. They also used part of the withdrawals to fund a joint last-to-die life insurance policy to replace any taxes at death. The results? Their lifetime tax bill dropped by $210,000. They preserved their OAS benefits well into their 70s, and their kids are now projected to inherit nearly $500,000 more after taxes. Part 4. Is the RRIF Meltdown right for you? This strategy isn't for everyone. It requires careful planning, and there are trade-offs. It may be a good fit if you're in your 50s or early 60s with a large RRSP balance. You expect to have other income sources in retirement like CPP, OAS, or a defined benefit pension. You want to minimize your tax exposure later in life and maximize what you leave behind for your family. It may not make sense if you're in a very low tax bracket now and expect to remain there in retirement. You plan to spend most of your RRSP in early retirement. The RRIF Meltdown isn't about one-size-fits-all advice. It's about customizing your withdrawals to fit your unique retirement picture. This is where a certified financial planner professional can help you run the numbers and design a withdrawal strategy that fits your goals. Part 5. What you should do next. Taking control of your RRSP strategy. If you're sitting on a 7-figure RRSP, the most important thing is to realize this. The decisions you make in your 50s and 60s will determine how much of that money stays in your family and how much quietly flows to the Canada Revenue Agency. Here's a simple 3-step process to get started. Step 1. Get clarity on your RRSP withdrawal timeline. Don't wait until age 71 to start thinking about RRIF withdrawals. Ask yourself, what will my income look like in my 60s, 70s, and 80s? Am I at risk of crossing into higher tax brackets later? Could starting withdrawals earlier help me smooth out my taxable income? This isn't about withdrawing as much as possible right away. It's about creating a deliberate withdrawal plan that fits your long-term goals. Step 2. Evaluate where to reinvest withdrawals. When you pull money out of your RRSP, you don't want it sitting idle in cash. Think about TFSAs. Reinvesting here allows your money to grow tax-free, and withdrawals are never taxable. Non-registered accounts. Using tax-efficient investments like Canadian dividends or capital gains-focused portfolios can reduce the tax lag. Permanent life insurance. For some Canadians, funding a tax-exempt life insurance policy can provide a powerful estate planning tool, replacing taxes with a tax-free benefit to your heirs. Every option has pros and cons, and the right mix depends on your personal situation. Step 3. Work with a planner to run the numbers. The RRIF Meltdown sounds simple in theory, but in practice, it involves a lot of moving parts. Understanding tax brackets in your province, coordinating withdrawals with CPP and OAS, planning for survivor scenarios and estate taxes. This is where a professional plan makes all the difference. Proper modeling, you can see how different strategies impact your taxes, cash flow, and legacy, and avoid costly mistakes. Here's the truth. A $1 million RRSP can be a gift or a curse, depending on how you manage it. The RRIF Meltdown is just one tool we use to help Canadians keep more of their retirement savings, minimize taxes, and protect what they've worked so hard to build. If you'd like a personalized retirement strategy designed around your goals, click the link in the description to book a free, no-obligation consultation with me. We'll sit down, review your situation, and show you how to draw down your RRSP tax efficiently so you can retire with confidence and leave more for the people you care about. If you found this helpful, give it a like and share it with someone who's saved diligently in their RRSPs but hasn't thought through the withdrawal strategy. And don't forget to subscribe for more Canadian retirement and tax planning insights.